Some people are DIY types. When it comes to any kind of project, including commercial real estate investing, they love the idea of doing it yourself. And I've got a lot of respect for those people because I honestly am one. But what about the rest of the world? That's probably the best way to think about commercial real estate syndications. The difference between DIY and done for you. If you love taking the time and effort of researching a market, making calls yourself, and laying down a bit more risk, you'll probably want to work with a brokerage. That's DIY. If you don't have the time for research, road work, negotiations, and paperwork, real estate syndications, the done-for-you choice in this analogy, might just be the answer. I'll say this, if I had to start over from scratch, I'd go all in on a trusted, proven syndication. So let's take a closer look at why I think you should invest in commercial real estate syndications, and I'll give you a little advice about how to get it done right. First, what is a commercial real estate syndication? Short answer, commercial real estate syndication is a way for investors to pool their funds together in order to buy a larger and more stable asset or multiple assets than any individual could have done on their own. You've likely seen the concept of a syndication at work in other industries. It's not a new idea at all, but for some reason, a lot of people don't know that commercial real estate can be invested in the same way. Commercial real estate syndications are a much easier way for people to invest in real estate because you can spread out your capital into multiple deals with multiple different sponsors. Those are the people that are sponsoring or actually championing the deal, which helps diversify your portfolio along the way. In its simplest form, you, the investor, find a trusted deal sponsor, the syndicator, and the sponsor uses their years of experience in the commercial real estate market to invest and grow your money. Sounds easy, right? Not that there are no downsides. We'll get to those in a moment. But syndication is definitely the easy button when it comes to commercial real estate. And yes, done right, it can be extremely profitable. Now for a few syndication buzzwords you should know. Before we start down that road, let's get familiar with just a few of the buzzwords that we use here in the industry. In a moment, you'll be talking like a commercial real estate syndication pro. Fees. So the fees in your particular deal are something you're going to want to watch very carefully. If you're working with a reputable deal sponsor, the fee structure should be somewhat simple and minimal. If not, just like any other business deal, those fees can start to add up and cut into the investment. Some common fees that you'll see in a real estate syndication include the acquisition fee, construction management fee or project management fee, a refinance fee or disposition fee, asset management fee, a loan guarantee fee. They can kind of go on, but those are probably the most common ones. Now for a syndication investor. Investors, which are also called the limited partners or LP, are the passive party in the investment. So that would be you. Now for syndication structures. There are many different ways to structure real estate syndications, just depending on what your goals are. And they can be as simple or as complex as you would like for them to be. I prefer to keep my offerings as simple as possible so that there's complete transparency and no potential confusion at any point in the process. So now for a general partner versus a limited partner. In layman's terms, a general partner holds most of the responsibility in a syndication deal. A limited partner is usually only contributing money as an investor, and they carry far less risk in many ways. Really, all that they are liable for is their initial equity investment. The general partners will be responsible for running the project, raising the capital for it, signing personally on the debt, or just signing on the debt. It can go on and on. 506C versus 506B syndication. There are two primary types of real estate syndications, and they are more commonly referred to by which investors are generally allowed to invest: accredited versus non-accredited investors. The 506B offering is referred to as the friends and family offering, while the 506C offering is for accredited investors only. Deal sponsor. The deal sponsor, who is also called a syndicator or general partner, GP, is the active party in the investment. Their responsibilities include finding and sourcing the investment opportunity, performing all the underwriting, putting together any renovation and operational plans, raising capital, placing debt, operating the day-to-day of the asset, handling all investor relations, tax returns, K1s, etc. They literally have almost all the responsibility. Waterfalls. Waterfalls are the structure agreed upon in advance, which will determine how the returns on your investment are distributed to you, the investor. Waterfalls can be simply structured or very complex, based on the nature of the deal or the parties involved. But essentially, look at it this way. As the returns on a project go up, it waterfalls down to different tiers where you as the investor will get a certain percentage and the general partner or the deal sponsor will get a different percentage based on the profitability. All right, now for the benefits of investing in a commercial real estate syndication. The pros of investing in commercial real estate syndications are nearly as good as it gets when it comes to an investment strategy. There are many of them, and they can include the nature of returns, tax benefits, and my favorite, they're almost completely passive. You can invest in larger assets and projects. If you're on your own, you only have so much juice. If you throw it in with others though, even though you only have a slice of that pie, it can end up being much larger than what you could have done on your own. Larger assets tend to hold their value better, and they're actually more liquid than smaller properties since the buyer pool is better capitalized and seeks the confidence and income that larger assets bring. More stability due to higher unit counts and or location. If you buy a single family home, which if you've been watching this channel at all, I highly recommend against, and your renter bails, your income goes to zero until you bring in another renter. If you join with other investors in a syndication and buy into multi-family or multi-tenant units, one of those renters leaving isn't going to send you in a tailspin. And real estate is all about location, location, location. So if you buy a site in a premium high demand area, you won't have to fight as hard to keep occupancy high as you would if your site was in the middle of nowhere, because that's just frankly what you could afford. Less money out of your pocket. Same point here, but kind of from a different angle. The combined power and knowledge of a group of investors is always going to be much greater than the knowledge you can ever acquire on your own. And that combined power also means less money from you up front, as well as greater returns on the back end had you invested that same amount on your own. Completely passive real estate investing and cash flow. Simply put, find an amazing deal sponsor, and as the limited partner, you're literally just placing your money into the pot and watching it grow. No hassles, no research, unless you want to, and I do recommend you do that on the front end when you're vetting a deal sponsor. No endless phone calls, no guessing, no work. This is truly as passive investing gets. The most responsibility you'll ever have is checking your bank account to make sure that the money is clearing. On-site and or professional management. Professional property management teams are the ones on-site each day dealing with the tenants, preventative maintenance of the building, repairs, budgeting, and so much more. Properties of scale have enough income that they can actually justify covering the expenses of a property management company so that you won't have to deal with all of that yourself, or rather the general partner in this instance, which you would be if you were buying the property on your own. That smaller property typically just can't afford to have a commercial property manager, which means you're going to be monitoring the deal better. You're going to be watching after the deal better. You're going to be managing the property and taking care of it much better with a commercial property management company. Tax benefits, forced depreciation, and write-offs. Since commercial properties are physical structures that age and experience wear and tear, the IRS allows investors to write off a piece of that against any earned income, which is called depreciation. Not to mention that since these are not active investments, unless you're the deal sponsor, you're taxed as a passive investor, which offers a lower tax rate. My favorite benefit of real estate investing, the forced appreciation. Like I said under property management, commercial real estate is valued based off of the income that you bring in. So if you increase that income, you can substantially increase the value thanks to capitalization rates and their inverse proportionality. Now for the drawbacks of investing in a commercial real estate syndication, because not everything is all rainbows and butterflies. Are there risks and drawbacks in investing in real estate syndications? Of course there are, just like any kind of investing. As you already know, nothing in the investing world is guaranteed. There are always ways in which things can go wrong. So let's take a look at some of the more common risks of investing in syndications. Increased vacancy due to rents being raised. This one is the mirror image to one of the benefits I already listed. Yes, as rents are raised in a normal environment, there will be some churn in vacancies. However, this risk goes both ways. Because you've invested in multi-unit properties, one or a handful of vacancies should not break the bank before you can fill them again. Construction cost overruns that lead to capital calls. We're seeing this more and more these days, which is often due to poor planning and or cost hikes on materials due to things like, a global pandemic going on that will literally shut down the supply chain. However, this is going to be a risk in any real estate deal you put together. And with your pooled resources run by a smart, hopefully experienced deal sponsor, this problem can many times be head off at the pass. Because let's face it, no one ever wants to do a capital call. Fortunately, we've never had to do a capital call on any of our investments, and there are certain ways that a sponsor could always avoid a capital call, like lending money to the deal themselves in order to avoid that, but it's got to be in there. You never know what could happen. Project delays due to weather, political environments, or more. This is another one that is not unique to syndications, but definitely deserves mention. I'd label this as out of my control, and though worth preparing for what you can do in advance, not worth worrying about. The bank could call a loan. Yeah, it happens. Again, not very often, but it does. This has the possibility of happening to any of us who borrow money from banks at any time. So it's another one of the out of my control bucket, hopefully, assuming all the financial ducks are in their respective rows. However, I would say that syndication could offer a bit more protection against this happening due to the fact that they operate with multiple investors. The general partner disappears overnight. I've witnessed this one firsthand, and it's not pretty. Outside of due diligence beforehand, there's not much that can actually be done in these situations. However, with an experienced deal sponsor that has a track record of successful projects, you likely won't need to be worried about any of these scenarios. It's important, however, that you perform your own due diligence and understand the risk you're taking on, whether you're the deal sponsor or an investor. Let's talk about how to find deal sponsors and syndication opportunities. So now that I've made my case, I obviously believe that commercial real estate syndications offer the best investment opportunity on the planet for many reasons. As I said from the start, if I had to begin again with nothing, I'd scrape some capital together, walk straight into a reputable deal sponsor's office, and place my money on the table. I mean, one, because I know that they would hopefully grow it for me, but two, I could also learn from it. If you ever want to go do your own deals as a real estate syndicator, the best way to learn is through investing in one. Now, I will say that finding real estate syndications can be tough because a lot of them don't, or just can't, advertise because of SEC regulations, the Securities and Exchange Commission. So many potential investors have no idea that these opportunities even exist. But I see this as yet another benefit to you, the investor. It's not a very crowded market. So if you do your due diligence, there's a lot of deals out there with sponsors looking for investors. And it can also mean that you have some leverage in terms of the deal. So how do you do that due diligence? Well, let's keep this to a few easy and effective steps. Go online right now. Without a doubt, the internet is an absolute miracle. This is where I'd start, and there are several places that I specifically recommend, such as Fundrise or CrowdStreet. You can make your search as detailed as you want within those platforms and likely find a syndication that works for you. Now, those are obviously crowdfunding sites. Well, crowdfunding is technically syndication. There are many other independent websites and forums that can not only be helpful, but life-changing in terms of getting you started. If you only do one thing to find your deal, go online and get researching. You could even type in commercial real estate syndication in your city. I mean, you never know what's going to pop up, right? A couple other ways to figure out how to invest in commercial real estate syndications would be to talk to your stockbroker or your wealth advisor. Now, they may have a conflict because they probably don't want you investing in something that they can't necessarily manage. But again, they typically know people who are handling those types of deals. Talk to your friends. Maybe your friends are investing in commercial real estate syndications. And look up commercial real estate syndication groups. There are groups out there and forums where you can go find other investors talking about which sponsors to and not to invest in. Go meet with deal sponsors. As incredible as the internet is, there's still nothing like face-to-face. When you meet a handful of vetted deal sponsors in person, it gives you the invaluable opportunity to decide if this person is someone you actually want to work with. And don't underestimate that. You'll potentially be giving this person a lot of money, like a pretty good chunk of your money. So can you look them in the eye and shake their hand confidently over it? If not, maybe don't invest with them. If you can, probably a good sign. Invest in projects that you're familiar with. This might be my favorite piece of advice. Just be who you are. Triple down on what you know. Don't try to be someone you're not. If you know storage, invest in storage. If you've got Nashville unlocked, do Nashville. Enough said. Now, old-fashioned networking. Let's go back a few decades and learn from our elders. Depending on where you live, it's likely that there are several real estate organizations or clubs or even bars where all the real estate people hang out. Find them. Go there. Be yourself. Meet people. Become actual friends with them. And finally, learn from them. These people are the real ones. The people that know what's actually going on in your area. You'd be amazed at the kind of intel that you can pick up. Intel that just might take you to the next level as an investor. All right, if you would like to dive into commercial real estate syndications more and just take your knowledge to the next level, check out this video here on commercial real estate syndications for beginners, and I'm going to give you a complete overview of what you need to know.